Hello everyone and welcome to our pre-recorded webinar, Understanding Flexible Spending Accounts. My name is Nicole Smith and I'm the Benefits Education Specialist here at Flex. I oversee all of our educational efforts for insurance producers, plan administrators, and plan participants. Today we'll be going over the basics of flexible spending accounts, including eligibility, contributions, reimbursements, and the various technical requirements associated with these plans. I'm also going to take a few minutes at the end to tell you a little bit about FSAs from Flex. Let's get started. So what is a flexible spending account? Well, it's an employee benefits program that's designed to take advantage of Section 125 of the IRS tax code. These plans allow employees to pay for qualified expenses on a pre-tax basis. Funds in the FSA are not subject to payroll taxes, which means that the employer saves on FICA taxes, and the employees save on federal, state, and FICA taxes. This typically saves the employer enough to cover the administrative costs of the plan, and employees typically save about 25 to 30% of the amount they put into the plan. There are two main components to the FSA: the Flexible Spending Arrangement, otherwise known as the Healthcare FSA, and the Dependent Care Assistance Plan, also known as the Dependent Care FSA. First up, let's talk about the Healthcare FSA. The Healthcare FSA provides tax-free reimbursements for out-of-pocket healthcare expenses. This includes expenses incurred by the employee's spouse and children, even if they're not covered on the employer's health plan. In fact, the employee doesn't even need to be covered on the health plan. They do, however, need to be offered coverage. One of the great things about the Healthcare FSA is uniform coverage. This basically means that the employee's entire annual election must be made available on the first day of the plan year. Essentially, this is like the employer is giving them the money upfront as a loan, and the employee pays it back through payroll deductions throughout the year. This does open up a liability for the employer, though, because uniform coverage rules say that they are not allowed to take this money back from the employee if he spends it all and then terminates employment before the total election is paid back via payroll. So, the employee could enroll in the FSA for January 1st, spend all of his money on January 2nd, and quit before he has a single payroll deduction. In that case, the employer would just be out that money. There is, however, a similar risk on the employee's part. This is because use it or lose it rules also apply. If the employee does not spend all of his money during the plan year, it's possible he may forfeit the money to his employer at the end of the year. There are a couple of optional provisions that employers can add in order to mitigate the employee risk. One is called the grace period, which gives the employee more time to spend down his election. However, once the grace period ends, usually 75 days into the new plan year, any money that is still left would be forfeited. Another provision, called carryover, was introduced just a few years ago. Carryover allows employees to roll over up to $500 of unused funds into the next plan year. There's no time limit for when these funds must be spent, but any remaining funds above the $500 will be forfeited. FSA eligible expenses are based on Section 213D of the tax code. They include basically anything related to healthcare that's not being reimbursed by another source, like health insurance. Some examples of this include health plan deductibles, copays, and coinsurance, as well as other things like dental and vision expenses. Over-the-counter items are also eligible, but it's important to note that OTC drugs and medications do require a doctor's prescription to be eligible. Other OTC items that are not considered drugs or medicine, such as bandages, thermometers, and contact lens solution, are eligible and do not require any additional documentation. The maximum election for the Healthcare FSA is set by the IRS. Now, this is a relatively new thing. It used to be that there was no statutory maximum, and each employer was free to set its own max. However, in 2013, as a part of the Affordable Care Act, the IRS imposed a maximum election amount for all plans. Employers are free to set a maximum that is lower than the statute, but they may not exceed it. The maximum is per participant, not per household. So an employee and his spouse could both participate in the FSA with their respective employers and elect up to the maximum allowed. This maximum started at $2,500 and was set to increase to match the Consumer Price Index. Now, for 2018 plan years, the maximum election amount is $2,650. An important note here is that carryover amounts do not affect the maximum election for the next plan year. So, I could carry over $500 at the end of the 2018 plan year and still elect $2,650 in 2019 for a total election of $3,150. The second part of the plan is called the Dependent Care FSA. This plan allows employees to use tax-free money to pay for dependent care expenses. If the employee pays anyone to take care of his dependent so that he can go to work, he can do it tax-free through the FSA. Eligible dependents include children up to age 13 and any other tax dependent who lives in their home and is incapable of self-care. This account can be used for things like daycare, preschool, before and after school care, and summer day camps. One important difference between the Healthcare FSA and the Dependent Care FSA is that the Dependent Care Plan does not have uniform coverage. The annual election is not made available up front, and employees must wait until the money is deducted from their paychecks before it can be reimbursed to them. The use it or lose it provision is in effect for this plan as well, so any unused funds will be forfeited at the end of the year. Employers can apply the grace period to this benefit, but the carryover provision does not apply to the Dependent Care FSA. The maximum election for this plan works differently as well. For dependent care, the maximum is per household, not per participant. So it works out to be $5,000 for people who are either single or married and file a joint tax return, and $2,500 each for married couples that file separate returns. These amounts are also set by the IRS, but they are not indexed for inflation. One question that comes up fairly often for me is, which is better, the Dependent Care FSA or the Dependent Child Tax Credit? Well, in most situations, the Dependent Care FSA is going to be more beneficial because the tax credit is capped at $3,000 for one child and $6,000 for two or more. For employees with two or more children, they could do the Dependent Care FSA for $5,000 and apply an additional $1,000 in expenses to the Dependent Care Tax Credit. Next, let's talk about eligibility. There are no restrictions on the size or type of employer who can offer an FSA. Any employee can also participate, except for those who are considered self-employed. People who are considered self-employed would be sole proprietors, anyone who owns more than a 2% share in an S-Corp, partners in a partnership, and members of an LLC. For S-Corps, it gets a little more tricky. It's not just the shareholders that cannot participate, but also their family members who work for the company. This rule applies to parents, children, and spouses of any more than 2% shareholder. Moving on to contributions. FSAs can be funded by either the employee, the employer, or both. One important note about employer contributions is that due to ACA regulations, employer contributions to a healthcare FSA cannot exceed either $500 or a dollar-for-dollar match of employee contributions. We actually don't see many of our employer clients contributing to the FSA, and employee contributions are by far the most common. These are done via salary reduction, so the FSA funds are deducted directly from each employee's paycheck. The contributions themselves are referred to as elections in the plan. These elections must generally be made before the start of the plan year, and once the plan year starts, they are irrevocable, meaning they cannot be changed unless certain conditions are met. These are what we refer to as qualifying change in status events, which do allow employees to make changes to their election in the middle of a plan year. So if someone gets married or divorced or has a baby, they may be able to change their election or even stop it altogether. Keep in mind, though, that the change in election must be consistent with the qualifying event. So if someone has a baby, he or she could come on the plan if not already enrolled, or increase their election. They would not be able to decrease or stop their election in this instance. Another question that comes up fairly often, especially with employees, is where does the money go? A lot of people assume that any money left over at the end of the plan year is kept by the third-party administrator, but this is not the case. Here's how that works. When someone signs up for the FSA, they are essentially agreeing to be paid less in exchange for having access to a fund of money which will reimburse them when they file claims for eligible expenses. For instance, if I make $50,000 per year and elect $2,000 into the FSA, then I am agreeing to reduce my salary to $48,000 for the year. For their part, my employer is agreeing to reimburse me up to $2,000 when I have eligible expenses. If I never file a single claim for the year, then I basically just got paid less for that year. My employer would then be able to keep that $2,000 because they never had to pay out any claims for me. Those funds would stay in the payroll account, and I would not be able to access that money. In fact, IRS regulations actually prevent employers from paying the money out to employees, unless they distribute it evenly amongst all plan participants. The rules also say, however, that employers must use the forfeited money to pay for the administrative costs of the plan. So, how do participants get money out of the FSA? FSA funds can only be reimbursed after eligible expenses have been incurred, and every eligible expense must be substantiated before it can be reimbursed. Substantiation just means that you need to be able to prove you incurred an eligible expense. Proper substantiation must include the date the expense was incurred, the name of the person the expense was for, the amount of the expense, the name of the provider, and a description of the service provided. Claims can be substantiated via paper, so the participant files a claim with a copy of the EOB. Via electronic data transfer, the insurance company sends the claim information directly to the FSA administrator, or via debit card transaction. After the claim has been substantiated and processed, reimbursement will be sent to the participant, usually via check or direct deposit. Keep in mind that debit card transactions represent payment at the time of service, so no reimbursement will be issued. Instead, the money is pulled directly from the FSA at the point of purchase. Remember earlier when I said that any employer could sponsor a flexible spending account? Well, that's true, but it's not quite as easy as coming into the office one day and just announcing that you'll now be offering an FSA for your employees. There are some technical requirements involved. In order to be legitimate, all flexible spending accounts must have written plan documents. These documents must describe the essential components of the plan, such as eligibility for coverage, the eligible expenses, claims processes, etc. The plan documents must be officially adopted by the employer prior to the first day of coverage under the plan. These can be independent documents or part of a large-scale document, such as an ERISA wrap document. There are also non-discrimination rules to consider. IRS regulations state that FSAs cannot discriminate in favor of key or highly compensated employees. When looking for discrimination, there are 3 key areas to consider. These are benefit design, such as an employer cannot fund the FSA just for executives; eligibility, an employer cannot make the FSA available only to managers; and utilization, meaning that the participants in the plan cannot skew too heavily toward key and highly comped employees. Okay, now that I've told you all about flexible spending accounts and how they work, let's take a minute to talk about FSAs from Flex. Our FSA comes with flexible spending accounts. That includes the Healthcare FSA, Dependent Care FSA, and the Limited Purpose FSA, which is an FSA that only reimburses dental and vision expenses. We also include annual non-discrimination testing that ensures the plan is compliant with IRS regulations, the premium-only plan, and plan documents and summary plan descriptions. Our FSA features include integrated free debit cards and automated claims feeds with health, dental, and vision plans nationwide. We provide an easy-to-use website and mobile application and online enrollment capabilities. We also include both pre- and post-enrollment support and communications, and our experienced staff supporting you and your employees. If you'd like to learn more about our FSA or consumer-driven accounts in general, you can visit us online at www.flexiblebenefit.com or give us a call at 866-472-5351. You can also contact us via email at marketing@flexiblebenefit.com. I want to thank you for watching today, and I hope you found this presentation helpful. Please feel free to contact us with questions or if you need more information. Thank you very much and have a great day.